So, what's the deal with the US economy for 2026? Well, according to one chief economist, the stage is actually set for some major growth. But, and this is a big but, there's a single massive risk that could bring it all crashing down. Let's dive in and break down that forecast. Yeah, the outlook for 2026 is, believe it or not, surprisingly strong. But the economist behind this forecast says there's one thing, and pretty much one thing only, that could derail the whole train. So what is it, and how does it hold so much power over our entire economy? All right, so here's what we're going to cover. We'll start with that really bullish forecast for 2026 and why there's so much optimism. Then we'll get right into that single biggest risk connected to the housing affordability crisis, which, affects a lot of us. And then finally, we'll talk about what could be next for the Fed. Okay, first up, a bullish 2026 forecast. So why does this one economist see such positive signs ahead? Well, the core argument is that some key economic fundamentals are really starting to align, almost perfectly. I mean, listen to this quote. I'm very, very bullish on 2026 because all the dials are really lining up right. Now, that is a very bold statement, but it's not just a gut feeling, right? It's apparently rooted in the idea that four specific policy areas are working together to create this really powerful engine for growth. So what are these dials that are supposedly lining up? Well, the analysis points to four key policy areas that are driving this positive outlook. All right, so here are the four pillars of this bullish case. You've got tax reform, regulatory reform, hammering out new trade deals, and this one's highlighted as being especially important, pro-energy policies. The thinking here is pretty straightforward. If you make energy cheaper at the source, that effect just ripples through the entire economy, right? It lowers the cost of everything from shipping stuff to actually making it. Okay, so everything sounds pretty good so far. But there's always a but, isn't there? What's the one thing that could derail this whole optimistic forecast? So after laying out this whole positive case, the economist gets asked a simple question. What is the single biggest risk that could wreck it all? The answer? I think Fed policy. And there it is. Not some international conflict. Not another supply chain meltdown. Nope. The policies of our own Federal Reserve are being called out as the #1 threat. So what's the specific criticism here? Well, the argument is that the current Fed has been, dangerously inconsistent. First, they kept rates way too low for way too long. Then they cranked them up too high. The economist also calls out how they've botched the job on their balance sheet. That's basically the portfolio of assets the Fed holds. And that they're still sticking to this novel monetary framework from 2020 that just doesn't seem to fit the economy we have today. And look, this isn't just some abstract economic theory, right? The Fed's decisions have a huge, direct impact on all of us, on our wallets. And maybe there's no better example of that than what's going on with the housing affordability crisis. Just let this number sink in for a second. 75%. A recent study found that a staggering 75% of homes in the U.S. are now considered unaffordable for a typical family. And by unaffordable, the standard definition is that it would cost more than 30% of your household income. That's a lot. You often hear older generations talk about those sky-high interest rates they had back in the day. But this chart really shows the crucial difference. Back then, yeah, interest rates were high, but the price of a house was a much smaller multiple of someone's income. Now, look at today. The scale is completely flipped. So even if interest rates are lower, the actual price tag on the house is so high relative to what people earn that it's just an impossible burden for so many. But it's not just about the cost, right? It's also about supply. And this is where the economist links the housing shortage to another major national issue, immigration. So the economist poses this pretty sharp question. He asks, why didn't we see a corresponding boom in terms of residential construction when we had the boom in terms of the illegal aliens? Essentially, he's arguing that as the population grew, which creates more demand for housing, the supply of new homes didn't keep up. And he suggests this points to a fundamental breakdown in our ability to build enough homes for everyone living here. So if Fed policy is the biggest risk, what's the proposed solution? Well, not surprisingly, the conversation turns to changing that policy. And that starts right at the top. And this is why the decision on who becomes the next Fed chair is being described as so meaningful. We're not just talking about a new face in a big office. The argument is that this is about choosing a completely different direction for the entire U.S. economy. The argument goes that the next Fed chair absolutely has to understand the difference between the Fed's main policy rate and what are called real-world rates. The interest rates that you and I actually pay on things like mortgages. And there's this great example. There was a time when the Fed cut its main rate, but mortgage rates, they actually went up. So the point is, the next leader needs to know how all the tools in the toolbox work, not just the big flashy ones. So at the end of the day, the outlook for 2026 really seems to come down to a choice. On one hand, you have these strong fundamentals that are pointing toward growth. But on the other, they're being threatened by a monetary policy that some see as seriously flawed. According to this analysis, the path we take hinges on one thing: who is leading the Federal Reserve? So the big question left hanging is this: will a change at the top be enough to navigate the risks ahead?